Hello good people, I'm Ayu Lestari. Welcome to my video. In this video, I would like to share corporate finance mind mapping. Corporate finance is one of subjects that you will learn at IPMI International Business School when you are taking the MBA degree. Good people, I would like to share additional information about our lecturer, Prof. Sembel. In addition to his extensive and impressive knowledge and resume, I would like to share the fact that he actually learned directly from a Nobel Prize winner, Alvin Roth, who won the Nobel Prize in 2012 for market design, and a grandson of two Nobel Prize winners, Eugene Fama and William Sharp. Eugene Fama won the Nobel Prize for the efficient market theory. William Sharp won the Nobel Prize for capital asset pricing model. This fact makes us really proud to be one of his students. Here is how we learn corporate finance at IPMI. Unfortunately, we need to do it via online class. We will have assignment, quiz, and exam. There is business simulation, case studies. We also learn from the movie and book review. The task and assignment will be divided into group and individual. We need to be familiar with YouTube, how it works, and how to make a good video. And the most important thing, it's okay to make mistakes because we will learn from our mistake. Corporate finance. We start with financial management, capital budgeting, security analysis, portfolio theory, capital structure, financial distress, fraud risk management, international finance, dividend policy, efficient market theory. Let's start with the financial management. The basic objective of a corporation is profit and wealth maximization, significant and sustainable value creation. In order to achieve that, they need to manage the capital structure, working capital, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. Asymmetric information between the owner and the investor generate a principal agency problem that can be overcome by using good corporate governance principles that are transparency, accountability, responsibility, independency, and fairness. 4 cornerstones of corporate finance. Core value principle. Combination of growth, return on invested capital, and healthy cash flow drives value creation. At the end, the growth and return on invested capital should generate healthy cash flow. Conservation of value principle. Value is created when companies generate growth. ROIC higher than weighted average cost of capital, and eventually higher cash flow. The expectation treadmill principle. Need to carefully manage both external expectation and internal fundamentals to maintain healthy balance. the best owner principle. A business value depends on who owns or who manages the company. Different owners have different strategies and unique ability to add value. Then, time value of money. $1 today worth higher than $1 in the future because there is an opportunity cost. Then we will also learn about present value and future value. Capital budgeting. When a company runs their business, they need to make a decision whether they will accept a project or reject the project. Some methods that can be used are payback period, net present value, probability index, and IRR. The best method that can be used is net present value. Why? Because NPV assume cash flow are reinvested at required rate of return, while IRR assume that cash flow are reinvested using the IRR rate. There is also rule of 72. This will help us determine how long it will take to double up our investment. Security analysis. In analyzing the company, you need to understand the financial statement. There are 4 financial statements: balance sheet, income statement, cash flow, equity. Balance sheet will show you the worth of the company. Income statement will show you how profitable the company is. Cash flow will show you where the money is. From this financial statement, you can check the health of the company by using financial ratio. Some of the famous financial ratio are liquidity, working capital, asset usage ratio, efficiency ratio, profitability. The next one, you can do fundamental analysis by checking the domestic, global economic, industry, and company. The weakness of financial statement that they only show the historical or the actual condition of the company. And some using technical analysis, using the historical data, see the trend, and to predict the future. Portfolio theory. Risk and return. Risk can be divided into systematic risk and unsystematic risk. Capital asset pricing model. We will learn about the correlation, beta, and variance. Five, capital structure. Capital structure is a long-term source of fund in the form of debt and equity. The famous theory about capital structure coming from Modigliani and Miller theory, where the portion of the debt and the equity has no impact to the company value. With assumption, there is no transaction cost, no taxes, everyone has the same information and borrowing rates, debt is riskless, and debt does not affect the operation. The next one, financial distress. What is financial distress? Financial distress is a condition in which a company or individual cannot generate sufficient revenues or income, making it unable to meet or pay its financial obligation. What can we do about it? We check on the issue whether it is a permanent problem or there is a turnaround opportunity. If the problem are permanent, then we can go to private liquidation, file for bankruptcy. For turnaround opportunity, what we can do are doing restructuring on the operation, asset, and the financial. While learning about the financial distress, one of the cases that we study is the famous leverage buyout from the RGR Nabisco. Fraud risk management. Fraud risk triangle. Why fraud can be happening? Because there is opportunity, there is a pressure, and there is a rationalization of the doing. What can we do to prevent the fraud? There are 4 types of incentive: physical, monetary, social, and moral. To prevent the fraud to be happening in the company, we can use whistleblowing system. International finance. Earlier, it started with the gold standard, and during the class we learn about the foreign exchange market, forex transaction, there is both forward, future, and option, and also arbitrage. Dividend policy. Should public company pay dividend to the shareholder? We should be able to answer this question: how much should we distribute to the shareholder and how much should be retained for capital investment? Some factors that affecting the decision are the liquidity, historical, earning stability, debt obligation, investment opportunity. Efficient market theory. This theory won a Nobel Prize in 2013. What is market efficiency? Prices reflect all available information. Thus, asset prices are fair prices. They are neither too high or nor too low. But the theory based on perfect capital market, where there is no barrier to entry, perfect competition, financial assets are infinitely divisible, no transaction cost, all information is fully available to every participant, no tax asymmetry, no restriction on trading. There are 3 forms of efficiency market: weak, semi-strong, and strong perfect capital. Weak means information contained in historical trading data. Semi-strong, all publicly available information. Strong, all information affecting the asset's value. The implication: future markets cannot be predicted based on available information or random walk. That is all that I can share. Hope we all can learn together. Thank you.